All right, traders, thanks so much for sitting through that intro video. Let's hop into gaps. Let's talk about fades. Going to discuss what is a fade, how do you play it, how do you spot it, how do you identify it, how do you make money trading it. Those are all things I want to cover in this particular class. Now, throughout the classes and the programs and the day trading courses that you've watched so far, and the gaps that you've watched me talk about, fades are the part that I haven't brought up a lot in the past. Now, the good news is these are still part of the gap series regarding the 4 types of gaps. This is just the part that occurs in an initial move of the actual retest. So we're going to be discussing this today, and before we really dive into it, one of the biggest challenges about fades is these are purely visual, meaning you have to know, feel, see, and understand what they will do beforehand. That's the challenge with fades. Now, I'm not saying they can't be done. I'm not saying that they're difficult. These were not my specialties, but I am getting better and better at them. And what I'm actually going to do is, I think in either May or June, sometime upcoming, I'm going to focus my entire month on just playing fades. That's all I'm going to do. So first and foremost, let's discuss what a fade is. A fade is the retest portion of the gap that goes in the opposite direction of the gap for a certain time period. That's really what a fade is. So the retest portion that goes in the opposite direction of the gap. So we all know the 2 types of gaps, right? You have a retest gap and you have a gap and go. Those are all the gaps, and that's it, right? You have bullish and bearish, but you have a retest gap and you have a gap and go. If you hop over to a really cool website called reallifetrading.com, you can click on tons of free content where I have the whole day trading series, obviously the 4 types of gaps, the ebooks. There's a lot of content here focused on and derived about gaps, and this is just going to be an inclusion of that. But this is still part of the retest gap and the gap and go. You can get fades with either type of gap and go or a retest gap. They are much more common, obviously, with retest gaps. And again, I'm going to be discussing that in depth today. So that's what a fade is. People call a fade to win a stock fades, or often term fills. So fades equals fills the gap. That's just the term. Now, the name obviously doesn't matter. I've mentioned that numerous times when I talk about candlesticks or gaps or any other type of strategy. Is really the name is pretty much irrelevant. You can call these whatever you want. So for example, if some people call a bullish fade when a bullish candle gaps up and fades, I think that's confusing. So I call them bearish fades usually. So a bearish fade meaning you're actually playing it, you're playing the trade bearish. So it's a bearish fade, meaning you're filling the gap bearishly. That's my preference. Sometimes I get the terms confused a little bit, but that's what I think a bearish fade is. Again, some people call them bullish fades because it's a bullish gap and it's fading down. But again, the terminology is really irrelevant. The reason I'm bringing it up today is because really today and yesterday in the day trading world were phenomenal fading opportunities. They were really, really good plays to trade in the opposite direction of the gap. I have hounded on and just talked about and discussed in depth plenty of other programs, day trading courses, day trading programs, day trading series that you should often play in the direction of the gap. And playing in the direction of the gap is oftentimes the easiest or the highest probability. But as you likely know, in the early morning is usually when fades occur in the first 30 minutes. First 30 minutes is often when the fade will happen. So if you're going to be, for those traders who want to do something fast in the first 30 minutes, it usually actually is fades. These are pretty commonplace, pretty common practices when you're looking at playing a trade in the first 30 minutes. Most of them are fades, and that is a gap fill. So in the very first 30 minutes. So usually, as you all know, in most classes, in most webinars and day trading series, I play after the first 30 minutes. Me personally, because that's when I play in the direction of the gap. So if you're waiting for 30 minutes, again, usually the spreads are a little bit better. The bid-ask spreads have calmed down. The volatility has calmed down after the first 30 minutes. You get more candles on the 5-minute chart or the 1-minute chart to kind of discern and decipher what direction and how exactly you're going to play that move. But for me, if you're going to be playing a fade, it does happen in the first 30 minutes. These are the more aggressive trades, and these are the ones that you're going to want to watch for. As mentioned earlier, a fade is very visual. You must be able to feel that the gap will fill. So if you're going to play a fade, you need to be able to feel that the gap will fill. That is why fades are a little bit more difficult, because you have to have a fantastic understanding of the gap sentiment. So fades are all about the gap sentiment. You have to get really, really good at feeling and understanding the candlesticks and deciphering who would buy, who would sell, where, when, and why. So let's go look at what I felt like was the most obvious fade yesterday. The most obvious fade yesterday was on BABA. And I'm gonna hide all my lines for a second, look at just the candles here for a second, and discuss why I felt like this was a very, very obvious fade. And I'm also going to talk about the difference between this gap and this gap. So as we're looking at BABA, you'll notice this is a black candle gapping down here in the purple, and this is also a black candle gapping down here on the red. As you likely have known at this point, if you've gone through my ebooks or videos or other day trading series or day trading classes, those are both a retest gap. The one in purple was an absolute monster. That was a very nice one. This one, however, was a fade. So the question that Richard is asking is, what do you use to determine between a fade trade and a continuation gap trade? So that's really what this program, this class is about right now, is when do you determine that? And it all comes down to sentiment. It all comes down to being able to read the chart and, most importantly, understand and determine how far has the trade already moved in the last few days or weeks. If you're looking for a fade, that is probably the number one question you need to ask. Look at the price of the stock and really answer the question, what would you do if you were already in this trade? So I'm going to point to, again, a few examples, a purple and a red gap. I'm just doing that for colors. Give me 1 second. All right, moving the screen over here. So here's the red arrow, and here's the purple arrow. We're going to dissect both of these gaps, because these are the exact same type of gap, but the sentiment is entirely different. So here on the purple arrow, the purple gap, what you have is, this was actually a very nice white candle gapping up. So this was a retest gap. And this was also, if you're looking at it, you can probably see we were above resistance. So those who are here live watching this right now, do you think that some people somewhere out in the world played this bullish on a breakout? Yes or no? What do you guys think? Somewhere in that purple circle right there, do you think someone out in the world was playing that as a bullish breakout? Yeah, absolutely. I would argue without question, because you'll notice that purple line that I drew, right? It's a nice resistance. It's gapping above that resistance. You have some really good volume right before the breakout, right? So the volume started coming in here. So there were certainly some people playing that as a breakout, or let's say that you took this trade. I did do this trade right here. Let's say you played it right here on the retest, right? White candle gapping up, retesting the gap, and then bouncing. So there were people going bullish here in this purple circle. They were playing the breakout. Which means when the gap happened in the purple arrow, the one I'll circle again right here. So when this gap happened, were people trapped, yes or no? More specifically, were there bullish traders trapped on this trade, yes or no? Justin said, it's a trap. Exactly, this was certainly a trap. So this gap was a very good gap, a phenomenal bearish retest gap, because there were a lot of bulls who were trapped. So remember, you have to determine how people are feeling. You have to see how far has the trade already moved. We could easily tell and determine that most likely some traders had some stops in on BABA. If they were in bullish, probably below the low of this candle right there. So there were certainly some bullish traders trapped there on BABA as it was breaking out. So that was a very nice gap. And again, how far had the trade moved bearishly? The answer is not very far. You literally had just one previous candle. Other than that, the trend up until that point, right, this trend was bullish. So this trend right here in green was bullish, but the bearish movement was very, very minute, if anything. So this gap right here was starting the bearish movement. It was really the beginning of the bearish move. It hadn't really had any bears up until that point. So when that gap comes in, it traps people. That's a fantastic gap. A lot of people are scared. A lot of people are losing money. It's a wonderful, wonderful gap. Very similar to this gap over here. Very similar to this gap, right? The gap's down from this white candle, right? The bearish gap and go. There's a lot of bulls up there. The trend has been going bullish. It's gapping and trapping, snapping necks and cashing checks. So that gap down scares people. Now, if we go back and look at the difference of the one that I'm pointing to in the red arrow, how far has the trend already moved? And the easiest way to spot that is just go over into the price of the chart and just do some quick math. So BABA was at 200 right here. And now BABA is trading down, trading down, trading down. Bunch of bear candles. We can count them. 1, 2, 3, 4, 5, 6, 7. 7 bearish candles. BABA goes from 200 to 165 in the course of 2 weeks. Now, I'm not great at math, but that is a 35-point move in 2 weeks. That is from 200 to 165 points in 2 weeks. That is almost 10%, almost 20% move in 2 weeks on BABA. So have the bears already shown up? What do you guys think? Were the bears already here? Yeah, the bears were already in the house. All right, the bears were already here. So looking at the movement, right? Looking at how far has it already moved, this helps you determine, are people being trapped or are people taking profits? Has the trend ended? Question mark. Are people trapped or profitable? Or are people now getting in? Question mark. So in this situation, right, we got to think about BABA. BABA at 200, maybe some people took a breakout, but the people who were playing a nice longer term buy low, sell high, if we can zoom out, is BABA at a support level of some kind? Yes or no? Absolutely. Beep. There's the support right there. I mean, a blind oyster could have drawn that support line. Support, support, support. So you're gapping into a support zone of some magnitude. So when you're looking for a fade, you factor in the fact, how far has the trade already moved? That's the biggest proponent of, is a fade going to be, is a fade going to work or not? Is a fade more likely to already have happened? Has the trend already established? Are people profitable? So remember, when I say that the bears were already in play during this entire move from 200 to 165, how do bear traders get out of their position? Well, you already know that answer. They buy to cover. So when they buy, 30% of that phrase, buy to cover, is literally what ends up occurring. They are buying. So when someone is buying something, the price is going to go higher, right? Demand is beginning to increase. Supply is beginning to decrease, and the price will go higher. So if you have a bunch of bears coming in and they start buying to cover, not only are they buying to cover, but you also have bulls who are going, hooray! This is at a 20% discount from where it was 2 weeks ago. I'm going to buy to open. So you got people buying to cover and buying to open. That's the sentiment of this gap. So fades, as most gaps are, but most importantly fades, are all about the sentiment. You have to be able to look at that chart, feel it, and go, yep, people are definitely taking their profits here. Either bullish traders taking their profit, which we're going to talk about in a second, or bearish traders taking their profit. So let's go look at another example. This is one that I played today on Facebook. It was a small gain, but I like it. So here's Facebook, and what we're going to do is we're going to draw two very, very obvious lines. Actually, just one obvious line. So here's the support, resistance, right there, and all I did was base that line off of this candle right here. So what type of gap is this, first and foremost? What type of gap do we have here on Facebook? White candle gapping up. Yep, exactly. It's a retest gap. So in a retest gap, I mentioned that retest gaps, so here's the move higher, right? So if I had to diagram it, this would be the actual gap itself. Gap action. So that's the gap. And then this would be in purple, the retest, and that would be the move higher. And what a lot of you work on and try for and attempt to do is play this move, which is the actual, buy the dip, buy the salsa, buy the dip. That is buy low, sell high, buy the retracement, buy the pullback, whatever you want to call it. That's what that is right there. You're looking to buy. The fade, however, let me do it in a different color. I'm going to do it in blue. This is the fade. So this is the fade portion of that gap. F-A-D-E. In blue. So you're actually playing that retest, which means theoretically you could end up playing the same gap twice. Now, personally, so that we all are aware, I have a rule in my plan that says if I play a stock once and I'm profitable on that trade, then I will not play it a second time. That's just one of my rules. Because I've gone back and looked at every time I play the stock a second time, I don't improve my P&L for the day. On average. So I just don't play it a second time. But there are many traders who are much better than I am. So, practice it, see it, determine if you're good at it or not. But that's the fade. The fade's actually the trading down. So again, this is what I like to refer to as a bearish fade. Bearish fade is when a very specific white candle gaps up into a resistance. The more white candles, or the larger the white candles, well, I could just say bullish candles. The more white candles or the larger the white candle, the more likely a fade. So that's what I refer to as a bearish fade. And sometimes I'll slip up and call it a bullish fade on accident, but that is a bearish fade. Again, that's just my terminology. You could call this whatever you want. It could be called the Dale Earnhardt Jr. of gaps. You know, it doesn't really matter. Call it whatever you want. The Tiger Woods of gaps. Mashed potato dance, whatever you want. But a bearish fade is when a white candle gaps up into a resistance, or again, just better likely, the more you have a bullish candle gapping up, you are going to get that sell-off. Because when you're dealing with bullish candles, right? When you're dealing with bullish candles, anyone who bought yesterday on Facebook, are they profitable? Yes or no? The answer is yeah, absolutely. And we can look at this candle. The cool part about bullish candles, it doesn't matter what color you use to denote bullish candles, but if you can look at a bullish candle and you say, for example, yeah, there's a 100% chance that someone bought that day. 100% chance. Because it's a white candle. So you know unequivocally, which is a good thing in the stock market to know for sure that something is something. It's a rare event. But you can say without doubt that someone somewhere in the world bought some shares of Facebook yesterday. So when that happened, they were profitable at open this morning. So when they are profitable, they sell. Right? Bullish traders who bought some stock, they sell to lock in their gains. So if they sell, there might be some other traders that sell with them. So this is a really good shorting opportunity. And remember, you need the biggest help will be to look at the gap and go, answer this question. If I bought yesterday, would I be selling at open today? Question mark. If you answer that question no, then don't look to play it as a fade. If you answer that question yes, then you should probably be looking to play that as a fade. Simple as that. So what I'm going to do is I'm going to show you how I played this particular trade today on a 5-minute time frame. Now remember, that's just the time frame that I use the most. I'm a more conservative day trader. I'm a giant chicken, but I'm also consistently profitable every single month. And that's really the goal, right? The goal is not to make a new Porsche every single day, only to lose your entire house a month later because you risk too much on a trade and you don't know anything about risk mitigation. You want to get rich slowly in the stock market. So I play 5-minute fades. I will give you some very specific rules today. We will also look at some bullish fades and talk about how to play those. And then I think we should be good to go. Now, I use pre-market a lot when I'm fading. Pre-market is very, very important. So I'm going to pull up this 5-minute chart. And what we're first and foremost going to do is pull up some steps, and I'll go through some steps. So bearish fades. Step number 1. Bullish candle gapping up. Step number 2. Even better if it's into a resistance price on the daily chart. Step 3. Look at pre-market and verify. I'll use another word. And find pre-market support and resistance. So those are going to be your first 3 steps. Bullish candle gapping up, those are easy to find. Number 2, it's better if it's into a resistance price on the daily chart. Number 3, look at pre-market and find pre-market support and resistance. Now, I will say with bullish fades, these are usually higher percentage gaps. 2% at least. So when Facebook was opening up, I think it was 3.5 and some change. So these are a little bit higher percentage gaps. I mean, just the percentage numbers are up a little bit more because, right, the higher the gap is, the more likely that someone's going to be selling it. But it's going to also be a lot about pre-market support resistance. So those are the 3 steps. So when I was looking at Facebook today, here was the lines that I drew. I drew a line there, and that was entirely 100% based on this resistance. I think you guys can all see that. All right, so I drew it there. That was one support resistance, and then there was obviously a support resistance here. If you draw one here as well, based on this support, this is again on the 5-minute chart, that's absolutely fine, totally adequate, not a problem whatsoever. All right, so we went over 3 steps. Step number 4, and again, this is just me personally. You are welcome to kind of tailor craft a fade to more your style and what you're really good at. But step number 4 is I wait 5 minutes. Step number 5, I love it if there is some buying on the first 5-minute candle. Long lower shadow or white candle. Long lower shadow, black candle, or white candle. Right, I want some buying to come in on the 5-minute. Why would I want buying to come in on the 5-minute? Well, that means that there's some buyers showing up, right? And if there's some buying showing up, then if it goes lower, those buyers will get trapped. So again, when I'm playing the fade, I do wait for 5 minutes, Richard. Yep, you're correct. So I wait 5 minutes to let that 5-minute candle form. Now again, if you are going to fade, there are 2 approaches. There are 2 approaches. Fades are very aggressive. You will need to be quick. I am going to scream. All caps. Fades are one of the most aggressive types of trading, I would argue. They're insanely fast. If you are a slower trader or a brand new trader, you're welcome to practice these, but they are quick. They're exciting, yes, they're fun. Anytime anything moves quickly, it's fun, but fades are very, very fast. So you either have to play it 2 ways. You're either getting in near open, like 20 to 50 seconds into open, and setting a stop above a pre-market or daily resistance. All right, so again, this is bearish fades, or you are waiting for the 5-minute candle. It's really one of those 2 steps. Simple as that. So pretty much as soon as it opens, you are shorting, you have a short open, and you are setting some stops. Which means, I think this is kind of obvious, if you're getting in near open, it means you've already begun to plan that trade 10, 15 minutes before market opens. Right? You see the stock gapping, you see the stock gapping up, you see the stock gapping up into a resistance, and you could have seen this resistance level right here on Facebook at 8:30 Eastern. So this is 8:30 Eastern right here, 8:30 New York time. An hour before the market opens, you could have known that 161.50 was a pre-market resistance, and you could have had a short there and then a short somewhere high, a stop somewhere higher. Give yourself some wiggle room. Always give yourself some wiggle room. Always give wiggle room on stops. Should be above pre-market or as I wrote, daily resistance. Mine is almost always above the 5-minute candle high. So if you guys want to know how I'm trading these, it's almost always above the 5-minute candle high. So again, I'm waiting for 5 minutes and I'm determining the sentiment and I'm kind of playing it accordingly. So these are very aggressive trades. And the reason I say they're aggressive is fades should move quickly per how they are, just how they work, their sentiment, the mentality of traders. Think about it. If you were in a trade and you bought yesterday and overnight you're up 3%, at open, how fast do you sell? Pretty much immediately, right? As soon as the market opens, boop, you're selling and you're locking in your profits right at market open. So fades should move quickly. If I am not at more than 2 Rs in 30 minutes, in 1 hour, I'm bailing. So fades for me have a 1 hour limit, max. The max I'm going to be in a fade is 1 hour. Unquestionable. That is one of my rules, like hands down, all day, every day, 1 hour. I mean, they should move fast. Right? So if I'm looking at a trade, if it's not at more than 2 Rs in 1 hour, I'm going to bail. If I'm profitable, if I'm not profitable, I will lower my stop to a very small loss or a very small gain or something. But again, right at an hour, I'm pretty much going to bail. All right. So we got step number 5. The other step 6, so step 6, set up entry, either shorting pretty much at open with a higher stop. Now I will put in brackets, can risk half an R or a quarter of an R on early morning trades. That can be part of your plan, right? Practice it. See how that works out for you. Because again, if you only risk half an R and it works very well, and you get 2 Rs, that's only 1 R of your actual Rs, right? Of your previous Rs. Or if you risk a quarter of an R and it goes to 2 R, you only got half an R. Now granted, it's still profit, but just something to keep in mind. If you're gonna risk less, I usually do. If I'm doing anything in the before 5-minute candle closes, I'm usually risking less than a full R because it's just very volatile and it's all about not losing a lot of money. So set up your entry. My entry, if I'm playing, so step number 7, my entry on the 5-minute candle is a retest, so stop limit of the 5-minute candle low with a stop above the high. That's pretty much it. It's nothing glamorous. So I will do a stop limit because it almost always retests. A high percentage of the time. So this was my pretty much my exact numbers right here. Let me just make sure these are my exact numbers. Give me 1 second. Yep, 159.90 by 161.65. Dan says I'm confusing fades with reversals. That's the exact same thing, Dan. Fade is a reversal. All right, fade is the reversal of the move. It's the filling of the gap. So this is my exact trade, 159.90 by 161.65. Right? You'll notice long lower shadow on the 5-minute chart. Once it broke the 5-minute time frame, stop was above the high of the 5-minute. It was also above some of the pre-market high, which made me feel good. And when this candle came in, I really liked the trade. So let's see, step 8, number 8, you will always get 1 or 2 retests. No more than that needed. So that's step 8. You will always get 1 or 2 retests. But if you get 3, it's not really going to work. So what I mean by that is you're going to experience the bearish S-curve, right? The actual retest of the move. So here's the bearish S-curve. This was the fast one, right? So that was 1 retest. And then here's the second retest right here. Boop. So that's the S-curve. Right there. That's the movement. Now let's do some quick math really quick. Let's do some math pretty fast. I got triggered into this trade at 8:40. Here's 9:40. So I'm not that great at math, but I can tell you that 8:40 and 9:40, that's an hour. Was I up 1 hour, ladies and gentlemen? Sorry, I can't remember what question I asked. Was I up 2 hours in an hour? No, I was not up 2 hours in an hour. So I exited. I took a profit. I got like 0.4 R's on that trade. Nothing amazing, but not bad. That'll happen. Fades should usually do this. That's what fades are supposed to do. They are quick. I mean, telling you, 30 minutes, you should be in and out in most situations. I'm a little bit more conservative, but so like I said, it's an hour. So after that second retest on the bearish fade, so when this candle right here came in, this bearish candle came in right there, I simply lowered the stop right above the high of this candle, which was the 910 central candle, and my stop, new stop, was 160.60. I remember that because I just like the even numbers. 160.60. I moved my stop below there. An hour into the trade, it wasn't working, and I bailed. Now, there's another interesting thing that happens at about an hour or 30 minutes into the trade, give or take. So let me leave these lines on here. I believe I'm at step 9. Step 9. At some point, turn off the extended hours and find out where that 10 EMA is on the 5 minute. Because remember, my teaching on playing bullish retest gaps is waiting for that stock to pull into the 10 EMA on the 5 minute chart and then looking to play it bullish. So if you turn off the extended hours on this situation and pull up those extended EMAs, you'll notice, ladies and gentlemen, where I exited was right on the 10 EMA on the 5 minute. Right about an hour. Almost like clockwork. So this one didn't quite hit it. It got close. And the ironic part is, honestly, I could have exited 10, 15 minutes into the trade and gotten almost the exact same amount I got. I think I got $13 more or something that I could have exited. I almost pulled the trigger to exit right here, but it wasn't quite at the 10. I wasn't quite at an R. That's the part where it's like, you're going to get better with experience. But it didn't hit the 10. Had it hit the 10, I would have exited, right? Because that's the part where I say look to go bullish. So if a fade does break the 5, trade down, and then hit that 10, that's where you're going to exit, almost regardless of how profitable you are. The better the fade, the better the farther away the EMA should be. Now, this is not a rule. This is just something you should always know about. Moving averages will always say no to fading. You guys need to know that for those who use moving averages. They will almost always say no. Meaning you can find a moving average on some time frame that's going to act as a support. If you can't, then it should be a no-brainer for you to take that trade. But I can almost always find a moving average that's going to act as a support. For example, if I hop over here to the 1 minute chart, which I said on all time frames, right? If I hop over to the 1 minute chart, right when I was fading. So you'll notice, trade down, trade up, it pulls into the 10. This is where I get triggered. You guys remember that? That's where I got triggered right there. So if I was waiting, I was like, well, let me wait for it to break that 10 EMA. It would have been right here. And then I go, well, there's the 20 EMA right there. And then if you waited for the 20 EMA to break in order to short, boom, you shorted right here, you got trapped. And then it retested, and then it rolled over. So there's always going to be a moving average in the way on some time frame, 1 minute or the 2 minute or the 3 minute. At some level, you have to be okay with that. And the goal is, of course, to figure out which moving average is going to be the strongest at which situation and which time. The 10 EMA, people often use the 8 EMA, is strongest on the 1 minute chart for the first 10 minutes. After the first 10 minutes is over, it's kind of irrelevant. The 10 EMA or all, the 8, they're all the same. But I personally use the 10, so I'm just gonna say the 10. 10 EMA is strongest on the 3 minute. I don't know anything about the 2, so I'm not entirely sure. For really about 20 to 35 minutes into the market. 10 EMA is strongest on the 5 minute for a while. That's a really good moving average. I would probably argue 2 hours. 2 hours into the market. And then after 2 hours into the market, the next strongest is usually the 20 EMA on the 5 minute, and then the 10 EMA on the 15 minute. So the only time you're going to use those are for late in the day fades, and those are rare. I take about 3 a month. So as you can see probably in the chat pane, a few of you are looking at fading Facebook right now. It's about 12:35 Central, 1:35 Eastern. So what I would do is I would flip over the 15-minute chart, turn on the 10 exponential moving average, and I would notice we did break the 10, but now we're at the 20. So we're right here in the 20 EMA. That's not going to be enough fade. So the only way I would trade Facebook bearish this afternoon would be if we take out and make a new low of this white candle. But there's always going to be a moving average that's going to say no. That's why the best time frame is really early in the morning. Because earlier in the morning, it's going to take you at least 6 minutes to trade into the 1 minute, the 10 EMA on the 1 minute. Usually. If it's a far enough gap, it can take longer. This was a slower gap, but if I turn off the extended hours here for a second, it took Facebook 9 minutes to trade into the 10 EMA on the 1 minute. So there was no moving average holding it up until the 10 EMA on the 1 minute. So again, that's just a quick fade. It could have easily bounced from there, but obviously didn't. So you're still going to have to get very comfortable at this pattern, the S curve. Right? And just like any other strategy, ladies and gentlemen, everything works, just not all the time. So let's go look at a bullish fade, which is when a stock gaps down and then you trade it higher. So we're going to go back over here to the BABA example from yesterday. And please note, I did not take this trade. I wanted to, so this will not be a real life example. This will just be one that could have worked. I like bullish fades a lot. I'm just not the best at them, unfortunately. This is probably one of my weaker skills, and I will do my best to get better at it. I hope this doesn't sound sexist, but women are better at fades than guys are. Women are better traders in general than guys are. So, just saying that to say that. But I have found that most ladies prefer fades. I don't know why that is, but they do. And they're really good at it. So if you are a lady and you're listening to this and you want to specialize in something, fades are probably going to be it, because I've seen a lot of girls just absolutely smoke these things. A bearish fade is when the stock gaps down and begins, sorry, I said bearish fade. bullish fade, because again, you're trading it bullish, is when the stock gap's down and begins to fade, fill the gap higher. Right? So that's a bullish fade. I have a few coaching students who play just bullish fades, and this is what they look for: 2 or more bearish candles gapping down. Now, this is just me, but I do not fade gap and goes. That's just one of my rules. Okay, so if it's a white candle gapping down, I don't fade those. Not saying it can't work. I'm just saying that I personally have not had a lot of success fading gap and goes. That's just me. But what I'm going to do is I'm going to point to the fade. So here's a fade, obvious fade. Obvious. 3 bearish candles gapping down into a support, so easy. Here's another one. Phenomenal bullish fade. You had like 7 black candles gapping down. Here's another one. Easy fade. 3 bearish candles gapping down. The stock had went from 204 to 170 in like 4 days. Here's another one. Here's another one. These things happen a lot. There are a lot of these trades. And the crazy part is, it's the exact same thing as a bearish fade, just in reverse. And I play it the exact same way. Again, that's just me personally. So here's the 5-minute chart. And the 5-minute chart is going to be a little different with, in my experience, with bullish fades. So, as mentioned, these need to move quickly. Most bullish fades fade immediately. Very rarely do I see or get a bearish candle to play the break above that high. That's pretty rare. So usually when they gap, they just open and start more or less running higher. For me though, still, if you do play aggressively at open, I can't type today, you can still go with half an R or a quarter R of risk and add to it later, or just be at least you're in a position. But most of these, when they open, they just start running. So it's something that you do have to plan before the trade happens. Could you have multiple setups where you buy at open and then you buy a little bit more at support, at a pre-market support, and then you have a stop really far away for an entire R? Yes. Yep, you could do that. There's so many ways to play these. It's really entirely up to you. Right? Play them with whatever you see fit, but I will kind of give you how I play them. So my step 1 is I look for small bearish 5-minute candles with a nice upper shadow of some kind, and play the breakout above it if there is not a lot of pre-market resistance in the way. That's just what I do. Is that right or wrong? Neither. It's just kind of how I play it. So small bearish 5-minute candles. If you do have, so I'll say step number 2, if there is a large bullish 5-minute candle, and I say large equals 1% of stock value in size. That's what large equals. So if it's a 1% in size of the stock value, it's pretty big. If there's a large bullish 5-minute candle, play some kind of retest or pullback. So in this situation on BABA, right, you get a huge bullish 5-minute candle. Now, you'll notice I will draw, so here's pre-market support right here, and here's pre-market resistance. And all of this you could have seen before the market opened. You could have easily drawn that support and that resistance way before market open. In this particular fade, you will also see that there was a pretty nice hammer candle right here for the pre-market support. So you can find some pre-market support on a bullish fade and look for limit buy opportunities to buy it as cheap as you can. And again, this is like everything. A lot of it works, just not all the time. So bullish fades, again, this is all my opinion, bullish fades still take longer than bearish ones. I almost always play the retest on a bullish fade rather than a breakout, because it will retest like high percentage. So for example, on BABA, 15 minutes in, bunch of buying, obviously that's the breakout. Type in a 1 if you guys would agree. That's the breakout. It's above pre-market resistance, huge white candles, volumes everywhere. That's certainly the breakout. So once I see that, which is again in the first 30 minutes of the market, that's when the fades are going to do their thing. Once I see the breakout on a bullish fade, I then find some type of support resistance that I want to buy a retest. So again, I did not take this trade, so this is hindsight, but I try to do my trading as subjectively as I can. This is how I would draw my resistance line on BABA. And I would have done a limit buy there with a stop below the low of all of that pre-market support. Boom, 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 boom. And also below the low of that white candle right there. Now, bullish fades, set it and forget it. These can take hours and usually do. But they can fade all day. That's the cool thing about bullish fades. So it's, again, your preference. If you have 30 minutes to trade and that's it, you're probably going to look to play bearish fades. If you're a little bit more of a patient trader, you can be by the computer and then walk away and then come back 4 or 5 hours later. You'd probably want to play bullish fades. Because bearish fades, they can fade all day, but it's a little bit more on the rare side. It can certainly happen, but bullish fades that just slowly fade all day long are fairly common. They're slow, they're arduous, and same thing on these. I mean, really, you want to just trade it. Your target really will be either the 15-minute, the 10 EMA on the 15-minute chart, non-extended hours, or some kind of daily old resistance, or 2R, 3R, trailing stops, whatever you want to use. Again, I'm just being honest, bullish fades are not my specialty. Unless I am away from the computer all day, and then I'm amazing at them. I'm just rarely away from the computer all day. I'm usually in the room with you fine folks, enriching lives, doing cool stuff, whatever it might be, making videos. I'm usually around, able to watch it, which is a positive and a negative. You know, there's pros and cons. I can certainly walk away, but it's no longer part of my plan that I have to, right? I built the muscle, I've got it. If I really need to, I can tell myself, okay, man, just hold this all day, and then I will. All right, I have the holding muscle. It's not a problem. So that's how I would play a bullish fade, right? Let it break out. If it is a big bullish candle, right? If it's a big bullish candle on the 5-minute chart, let it break out and then play a retest. And you can be pretty conservative with the retest. If you think it's not going to pull back that far, let it pull back a little bit farther, right? You probably can buy it cheaper than what you think you can, is what I'm trying to say, on a bullish fade. Those are the only two types that I play, and the one that I play most frequent is the bearish fade. That is my specialty that I'm trying to adapt and get better at, is the bearish one. The last one that I traded, do you remember, Robert? I can find it. I'll find it in a second. I'm going to have to go through some of my trades, but let me see if I can find this one. This was last month when I was trading like last week when I was trading like Michael Phelps swims. Just give me a quick second. It was March. Late last week. It's just it's kind of like a random fade. USG. USG Corporation. All right. So I was looking at this trade, and this was the gap. So obviously we can see the gap. So first and foremost, here was the resistance, right? So remember, the open of giant bearish candles represent a resistance. Number two, can we look at this chart and say for sure that whoever bought here was profitable? Yes or no? Yep, absolutely. They were certainly profitable. No way they couldn't have been. So a lot of people who had bought that stock before that would have been profitable on that gap up. So this was the 26th of March. So here's the 5-minute chart. Let me go back to the 26th of March. 326. Here we go. And pull this one up. All right. So let me kind of scooch this in. So here's what we have on USG Corporation. So you have a pre-market resistance that kind of failed, right? It traded higher and then broke down. And we were trading up, and we had a small black candle, but it had a lower shadow. Now, just because it had a lower shadow doesn't mean I was going to take the trade, right? It doesn't mean that I was like, oh, that's, just because it has a lower shadow and it's a black candle, I'm going to take the trade. It also depended on the daily chart, right? The daily chart had a huge gap, so I was like, yeah, I think some people are going to be selling. You had this candle, whatever the heck this thing was. There's nothing in that candle that says support to me, right? There's nothing that says, hey, this is going to be a support price. So it could have theoretically traded all the way down here. This was the trade that we did on it, and it wasn't anything special, but it was a profitable trade. So this was the exact setup back on the 26th. So this was the posting. And what I did is I didn't see this trade exactly when the 5-minute candle came in. That would have been great. But you'll notice this is on a 5-minute chart. You'll notice my stop is above the 5-minute candle high, but it's also above the high of that bullish candle. There was a nice high wave candle that formed, and then I simply shorted below the low of those two candles. I shorted below the low of this lower shadow. So what was happening is when I was setting up the trade, I had a high wave candle here. Now, had I shorted there with a stop right there, that would have been a really good trade. I just didn't quite get there in time. Now, what you will also notice is, I don't know if I can put moving averages on without this chart changing, but I'll try. Ooh, cool, I can. If I turn extended hours off, I know it's going to change. Okay, so let me turn off the extended hours so that you can see the moving average. And what you'll see is the stock was pulling into the 10 exponential right here. It was getting very close to that 10 EMA. So this was the retest gap portion, right? This is the part where traders would have gone bullish. And so I bought to cover the shares right there. So we had been in for 5, 10, 15, 20, 25, 30 minutes. I was at about 1R We were coming into the 10 EMA on the 5, and I just got the feeling, and so I exited, and we got 0.86 Rs on the trade. Nothing glamorous. Now you could have said, "Hey Jeremy, how did you know how to do? How did you know to exit there? It didn't quite hit the 10." That's just 10 years of experience. There's no other way I can describe it. I mean, when you trade fades, like I mentioned, a lot of it is from feelings. You're going to have to practice some of these charts. Worst case scenario, as I mentioned earlier, you're going to likely get 2 retests. This was 1. This was 2. Right? That was the other reason. So you got 2 retests. If you said, well, Jeremy, all of this looks like 1 retest to me, I would have said this is the second retest. That's fine. And if you had done that, you'll notice it came right down to the 10. And if you exited there, or if you just lowered your stop to right above that candle, you still would have made a little bit of money on the trade. Not a lot, but you would have made probably 0.2 Rs. Because this is the area that most real-life traders would actually probably be looking to go bullish right there or right about there. So again, fades happen quickly. I would have obviously preferred to have gotten it here with a stop above there, and that would have been very close to 2 Rs. But I almost got it. I didn't quite do that. I shorted here by there. And so again, it just wasn't a picture-perfect trade, but right at an R, which is not bad. So very rarely, for me personally, do I get 2 Rs on a bearish fade. Most of them are 0.8, 1 Rs, 0.4 Rs, but I actually have a pretty high success ratio with them because they are supposed to work so fast. As soon as I get into a trade, I have that clock ticking down. I haven't lost a full R on a bearish fade in a while. I'm sure there is one that has happened, but I can't remember a time, which is usually a good thing because I have a pretty good memory when it comes to trading. So if I can't remember a fade that I got stopped out on for a full R loss, that's a really good signal. There are obviously other ways that you can play fades in the afternoon. There are tons of other approaches that you can play. Again, when stocks are breaking down, when supports are not holding up, when moving averages on different time frames aren't acting as they should. But those are going to be, so like I said, Facebook right here. We were looking at Facebook just a moment ago, and there was that 20 that was holding it up. So if we go to the extended hours, right, we can see that what it did was simply, and quite simply, just take out this support right here, retesting it, and you're not going to get a lot of movements on fades. Okay? You're very rarely going to get those 2, 3, 4 Rs. It can happen. It certainly can happen. It's often better if you want a 2 to 3 R trade on a fade, plan on being in it all day. So that's what I'm gonna write that in there for you. If you want 2, 3 Rs on fades, plan to hold for 3 to 4 hours. Not saying it can't happen, right? So had I shorted Facebook, well, not had I shorted, where I shorted Facebook from where my stop was, if I just walked away and literally let this thing play out for 3 to 4 hours, I could have gotten 2 Rs, 2.5 Rs on that trade, which is not bad. That's fine. I probably should have done that. But if you want the 2 to 3 Rs, I would say 90% of the time, you're going to want to hold much longer. Otherwise, it should happen in that first 30 minutes, maximum an hour after you get those 2 retests on a bearish fade. And if it doesn't happen and you want to bail, you're more than welcome to. Because like I said, on USG, had I held for 3 to 4 hours, I would have lost an R. So there are appropriate times. It takes practice. There is no proper way to make money 100% of the time. It just does not exist. Your goal as traders is and always has been, create a plan that has certain rules that you can follow that do the absolute best for you to lose money as small as possible, and then simply follow that plan and just be patient. It's a beautiful, beautiful blend the market is of being patient yet aggressive, knowing when to be patient and knowing when to be aggressive, and that takes practice. If you know there was a situation where you were not patient enough, write it down. And the next time you get an opportunity, just practice being a little bit more patient. So there will be a month, I haven't decided yet, it's either going to be May or June, where I do just practice fades the whole month, and that's all I do. And I might even do 2 months where I do 1 month, I just do bearish fades, and 1 month I do bullish fades, because that's how you get good at stuff. And yeah, I'm risking some income, because what if I don't actually make money that month? That's okay, that's fine. That'll happen, that might happen, I don't know. But there's always the chance where if you trade and you focus on losing as small as you can, being conservative, being patient, but yet also being aggressive, that nice little blend, then trading is, as you all know, one of the greatest ways to consistently make money every single month, especially when it comes to time and how quickly it can be done. So I hope this was helpful. Does anyone have any last minute questions for those who are here live watching this presently? Robert says, that was an R there on the retest of the pre-market low. Yes, it was. A quick little R on Facebook. I love playing Facebook. Very liquid stock. Very liquid. All right. Well, awesome, folks. I hope this was helpful. Feel free to watch it as many times as you want. For those who are here watching it on my YouTube channel, please hit that red subscribe button. You can also follow me on Twitter at Newsome Nuggets. I'm on LinkedIn. We're on Facebook. We're on Instagram. We do the whole social media thing. Our mission, ladies and gentlemen, at Real Life Trading is to enrich lives. Folks from around the world, thank you so much for being here. You will notice there's absolutely zero sales pitch in this webinar, in this video, in this content, and in this information. Go tell your friends, your family, tell them about the stock market, tell them about how to become financially independent traders, tell them how to be good, which is getting out of debts and providing for their community, and teach them how to go enrich lives. Folks from around the world, you are amazing. Thanks so much for being a part of this. And until next time, remember, love life, live life, and trade it. You guys rock. Bye.